small business sector has been getting crushed. 6 out of the last 7 months for small businesses have been negative job growth, according to the ADP data. That's recession.
Large cap tech growth rates are big enough to hold the 30-year up here, and it's alienating the rest of society.
This is what's so weird about what happens when you're running an economy and a society with inflation above target for 5 years now.
This is central banking's endgame.
Yeah, 100%. This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another random edition of Forward Guidance. We are back. Long weekend is over. Back to the trenches. What's going on, guys? How's your Thanksgiving?
Am I still bloated?
Yeah, dude, I ate so much. I ate an unbelievable amount.
You look great, Quinn. You still got that slender figure.
Yeah.
Are you hitting on me? You creepy old fart.
I'm jealous.
Yeah. I like the old guard hat you're wearing today, Guggenheim.
Yeah, baby. It actually, on the back, it says leveraged credit. It's kind of cool.
Yeah, there's a couple things to say about that.
Speaking of which, how many guys, this is kind of fascinating. I worked at KBW, which is like a boutique investment bank that just covered banks when I was right out of college. And a lot of those guys, because they understood banking, ended up in crypto. Is there a lot of guys from leverage credit kicking around crypto too? I feel like that's an easy transition.
Yeah. I mean, the thing is though, debt, people are so downside focused. They're not really equity thinkers, upside focused. So making the leap into tech and stuff is less of their speed. They go into stable manufacturing, private equity, and funds and stuff. But I'd always been a little bit more, upside, more of an equity or macro growthier type of thinker. And then I started my career in 15 and then left in 21. It got to the point where every deal you're arguing about 10 to 25 basis points.
Yeah.
And you have no leverage, private credit, and the growth of everything just became a Cov Light term loan. There was no nuance. So you had to either go into the distressed restructuring world or kind of growth equity or private credit. But yeah, it just kind of got pretty boring.
You know what? That nails. So this is kind of fascinating. I was just kicking around Peter Thiel secular stagnation quotes, and I came upon this one today. It says, "Finance epitomizes the indefinite thinking because it's the only way to make money when you have no idea how to create wealth. If you're afraid to fail, then you should go and become a banker." And I was just how much arguing about basis points and that it's a fear mentality versus I don't want to lose money rather than here I can create something and grow the pie. And I that transition from your career, not to bring it all together, but it's leveraged finance with just fear-based investing to crypto is kind of what our generation should kind of look at after as a model. Because that's I don't know, at least you're trying to grow something, right?
It's much more, win or lose, there's ups and downs, and it's, doing different things is maybe not as stable as clipping the coupons on the street, but it's more fun. Come on.
There you go. All right. So in light of Thanksgiving that just happened, we had the Black Friday sale. I want to talk a little bit about some of the data that come out here because it really hits the nail ahead on a few different big themes we've been talking a little bit about. So 9.1% increase in sales year over year at Black Friday. But look at this one, down 1% in terms of item volume for the last year. Price is up 7%. Consumers bought on average 4.1% fewer items and an 11% increase on buy now, pay later usage. Klarna specific use up 45% by volume since last year. Man, we can riff on all of these and how they all come together into the state of society right now. So, okay, I want to dig in on the first couple points first. So this is what's so weird about what happens when you're running an economy and a society with inflation above target for 5 years now, is that suddenly, we've been so used to this regime for decades where there was no inflation. So, if you saw top line revenue, which is a nominal metric, increase, you would assume, okay, consumer spending, all is well, things are good. But you have to actually look at volumes now, because you need to better understand, where is people's purchasing power getting them, and where is it getting them? They actually are being able to buy less things, 4.1% fewer items, even though the amount of sales top line revenue increased 9%. So you have this crazy situation, which is just, again, K-shaped economy. You have people aren't getting as much as they used to with their money, but earnings growth for these corporations are seeing 9.1% top line revenue growth. And then as they scale, economies of scale kick in, they're selling more. It's great for their earnings growth. It's great for EPS. It's great for PE multiples, but it's terrible for how it feels to be the consumer. And then what do? They still need to, or maybe not need, but want to buy more things. And so they start to go out on the risk curve. They start doing the buy now, pay later type thing. Man, all this data is just the zeitgeist. What's your guys' read? Tyler, what's going on in your head?
Oh, it's just a microcosm of the whole thing altogether, which is boomers are buying, 10-year bonds at 4%. So they're actually financing a lot of this stuff, which is, they're buying a bond at 4%, but inflation's really at 7%. And so they're net losing 3%. It's everything we talk about, but they're incentivizing the K-shaped economy where the lower tier consumer uses Klarna to consume things. And it's just, we all know how this ends, is like, it's either helicopter money for the lower class once they start defaulting on their credit, or the whole system unwinds, is my read. But I think what they're going to do is just, we're seeing, we'll talk about asset later, but I think the market is front running some potential easing next year, and that might be able to kick the can and get money going into equity. So that's where I'm thinking about this.
The next slide, Felix, or we just put it down, but is the retail sales index. I think the only explainable way to think about it is that, if you zoom out, fiscal deficits, although the growth of government spending has slowed from Biden's last year of like 11% to now 3% this year. So it's better, but it's still, spending is still growing too much and unsustainably, and the deficits are still well above 5% in the 5 to 6% range. So at the end of the day, getting a nominal recession when the government's supporting the economy by 5 to 6% of GDP each year is virtually impossible, at least a nominal recession. And the thing, we can transition into it, but it is, when you pair this with the employment data, it's a mind boggle, because you have so many components of the economy weakening, to a large degree, particularly on the small business side. And you have, because as we know, it's never been, not only has the stock market never been more concentrated, the wealth and the percentage of spending comprised, done by the wealthiest cohort also has never been this concentrated. So it's all the same, that it's all one trade of keeping asset prices elevated so spending stays elevated. And we have a weekly show, so these themes recur a lot, but it's kind of wild to think that, this might go on until 2028 to 2032, over the course of the next presidential elections, until the younger generations really get over, the boomer hump of power.
I think the framing of nominal versus real recession is really important. So it's something I've been thinking a lot about recently. And like, if you look back at the 70s, the last great inflation, like, we would get a quote unquote recession where real growth was negative because of just how much of it was inflationary. So nominal stays elevated, but real growth actually stagnates. And it feels like that's sort of where we're starting to head towards. And, maybe you want to call it stagflation. I think it's a loaded term these days, but it directionally feels like why it's so confusing right now. Like, we got some interesting labor data this week from the ADP employment change. And if you look just a little bit deeper here, so this is like a new weekly index that they have as well, where they're tracking like weekly, losses of labor strength, and you can see a lot of the losses, a lot of the layoffs, a lot of the negative jobs growth is coming from small businesses. It's just this exacerbation of the small business sector that does not have access to public markets, where you have passive funds that are just buying up their equities and floating the whole thing. They're in recession. Meanwhile, anything that can have access to big public markets like the Mag 7, they're doing fine. It's so confusing to me.
And what's even more confusing on this point is that today we saw a rotation. Basically everything that was rolling over when we saw credit spreads widen a little bit, we saw banks rolling over, we saw private equity rolling over. The credit cracks were happening because the Fed got too tight on their forward guidance. And now all those things, now you get a weak data point in small businesses, and it's like Hassett, Fed funds, forward, okay, the easing cycle is on. All those things are actually leading us to the upside and outperforming to the upside now. Whether that's a squeeze or not, we'll see. But it's just, it goes back to the point of how messed up like forward guidance and central planning is now, that you can go from like 2 weeks ago, borderline like credit rolling over, constricting the economy in regional banks, in private equity, to completely reverse off of just essentially Fed policy. It's wild.
Jim Carsano always makes the analogy: multiples don't matter over any multi-year time horizon, or valuations don't matter. It's just a gauge of how high the airplane is above. And we talk about it, but it's just liquidity driven. Felix, if you want to go to that slide 18, I think what's fascinating about this ADP print, I plotted against yields and oil. So small business sector has been getting crushed. We've been talking about this forever. 6 out of the last 7 months for small businesses have been negative job growth, according to the ADP data. That's recession. Like, that's full on recession for small businesses. And it has to do with the way the Fed and Treasury together they hiked rates on the front end, constricting small businesses. And then they did covert QE, yield curve control, on the back end via ATI and these things. And that helps the large caps. But this chart, it's kind of might be tough for you guys to see, but the blue line is the ADP monthly. So if you trace that current level of negative back, historically, this is only like 10 years. It's like recessionary-ish type of levels of job growth. And normally yields with the yellow line, this is the 30-year yield, it's relatively correlated. But look at the jaws opening up. The yields line is in a straight line vertical trend, and we're at recession level job growth. So
this is central banking's endgame.
Yeah, 100%.
So this is the predicament of the Trump admin, because then the other line in there it's a little duller is oil, which is in some respects very similar to small businesses. Not always, but it's a gauge of Main Street economy. And so the dilemma, I think, that Bessent is going to face next year is going to be even larger than this year, because you're looking at a situation where if ADP job growth is like this a year from now, midterms aren't going for Republicans. Like, that's just, it's not happening. Yeah. So they need to get
counting for president.
So they need to get that number up. But that up means the economy heats up even more, the real economy. So I don't know. I mean, there's a lot of ways 26 can go, but, looking at some of these commodity charts coiling up and things like this, it does definitely put a 2022 like scenario on the table, I think.
Yeah, I think you're right, Tyler. It's the end game. Like, if the saving grace for long bonds has been that anytime there's a growth scare or an outright recession, you get the long bond bid, and that pulls things down. Yields come down very aggressively, and I think
now people are like, seeing, fuck that.
Yeah, exactly. And I mean,
go to the next one, Felix, too.
Yeah. This was the big scary moment of 2020 and even April, is that once you start to see Treasury markets begin to dysfunction, all hell breaks loose.
Mm-hmm.
This is a global sovereign debt benchmark. So it's the tightest, shortest maturity in basically 10 years. So it just shows that it's this slow trickle of governments basically making their long ends obsolete. because I mean, in Japan, the things don't even trade.
Go back to that previous slide, though. You know what this also tells me is two things. Number one, gold is becoming a global reserve collateral before our very eyes as the 30-year rises. And the other thing is, you could make the argument that the economy is held up, the growth of the economy with the 30-year up here is basically held up by all these centralized, large cap tech players. And this goes to the David Sachs point, which is if AI doesn't work, we have to back AI, because if it doesn't work, we're actually screwed. And it, in some ways it's really true, but your only outcome is to just make the bigger. And I think that's my point being, is that large cap tech growth rates are big enough to hold the 30-year up here, and it's alienating the rest of society. And this is the pitchfork scenario.
If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
You're talking right into a couple really good slides on this point that I found too. So I've showed these a lot, but every day we're basically pushing a new high of record market cap weight in the top 10, up to almost 80% of the market cap is in the top 10 stocks. And then the next slide, Mag 7, exactly what you just said, Tyler. Mag 7 forward PE is 48% higher than that of the other S&P 500 members, suggesting the market continues to extrapolate the success of the largest companies forward. Basically, the market's saying, calling the government's bluff. They're like saying, you won't fix inequality.
They really need to break apart these companies and make them into 40 different companies, because they keep getting these flows from the 401k system, and it just lowers their cost of capital. And, I mean, we're going to be in big tech dystopia in no time. I mean, we probably
the
are.
401k is also something. I mean, that's all government mandated as well. The passive bubble is driven by these restrictions and rules, investment requirements on these big pensions. And the last one, just on this point, Augur has some really good charts, is NVIDIA's weight in S&P is larger than 5 of the 11 sectors: staples, energy, utilities, real estate, materials. It's
our economy just turns into a one-trick pony. And maybe that's, I don't know, maybe it's so productive and AI takes everything and makes everything better, and we don't have to do much except entertain each other, and we all go on OnlyFans and become sex slaves. Maybe that's the end game. And yay, fun.
Endless AI slop. Yeah.
But I don't know. It feels silly to me as you're going to get some weird social outcomes. People are just going to get weirder and weirder.
Yeah. I've been thinking a lot about what the catalyst will be for this, because as long as you build out AI data centers and buy GPUs, yes, that's going to increase the investment portion of GDP. And then, they can just all, do the same deals in a circular fashion to each other. And then that pumps equity prices. And then all the boomers that are in SPY and QQQ, their portfolios increase, and then they can keep spending. And it's just this recursive loop. And so I'm trying to figure out what is going to be the catalyst. And I think one of them might be is when the depreciation or amortization schedules of all this AI CapEx spend starts to kick in. And, this is the Cuppy argument, but I think he's a little too early towards it. You need, right now we're in the phase right now where they're just throwing money at these things, and we haven't hit the meaningful momentum and depreciation of all of these assets. But in a few years, you're going to get to this point where we need to start thinking about either these getting marked down on balance sheets, or beginning to even think about replacing them. And then as that occurs, suddenly it's been all well and good while we've been able to do all of this without that long tail hit of depreciation and amortization hitting the balance sheets. But that's going to start to come forth in a couple of years' time. And when it does, I wonder if that's one of those catalysts, because, do we just assume that we can just keep funding these into eternity and we're just going to endlessly replace them? Like, it's not the same thing as when we were building out, I don't know, internet cables or the railroads across North America. Like, those are things that have much longer winded amortization schedules. This is a lot more short term. And so I don't know. I'm curious if you guys have any other thoughts in terms of like catalysts of, because obviously you don't want to fight this right now. Like, it's still ongoing. It's just getting more acute.
You know what? Bill Cower told me one time, don't let the facts get in the way of a good story. And so this is a good story. and stories can run for a long time. So I don't know. I think really what you have to see is defaults in credit somewhere, or somewhere where the credit market starts telling you they're not going to provide, credit. But I was reading, there's a great guy on The Information that writes about some of these data center deals and how they're structured. And he's basically saying there's like overwhelming demand for the Louisiana meta plant. It's like Owl Capital raised like I think Blue Owl raised like $30 billion at the drop of a hat to finance these things. And I don't see that going away anytime soon, even if you have like depreciation write-offs. It's really hard. It's so hard, especially
the levering up phase is still early. Like, they're not that levered.
Yeah. For the large caps.
They're not, but we have to also remember the magnitude, NVIDIA's $5 trillion market cap. Apple's up like in a straight line, 50% off it. Like, these numbers are getting so big. So yes, they're not that levered, but okay, if the combined market cap of Mag 7 is like 20 to 30 trillion, then, or whatever it is, they can't be levered, because if they're 5% loan to value, that's $1 trillion. If they're 10% loan to value, that's $2 trillion. If they're 20%, and then you're talking the size of debt issuance equivalent to the U.S. Treasury. The U.S. Treasury issues like $1 to $2 trillion in new debt per year. So like, the numbers are getting too big at some point. And so I kind of think, yes, it kind of stays going. I would actually be probably a seller of Mag 7 here relative to the rest of the market. But I think what I'm watching for is the cost of capital stuff, because in 2022, when you had the interest rate rise on the long end and all rates, like, these things were cash flow generative. They didn't rely on debt. But now, next year is the first real full big year that CapEx is going to be very debt funded, now that they've eaten into their cash flows. And these supply numbers are getting just nominally massive. And that combined with, how many times, like, how much can Hassett and these guys lower the rates and juice without people saying, okay, we're buying commodities, like, fuck this. Like, look at the BCom chart, that rounded bottom, like, multi-year base cup looks like crypto in 2023 kind of thing, where you're just like, oh my God, when this gets the switch flipped, it's going. So to me, I think when you have this midterm election dynamic and they will have to stimulate, the cost of capital becomes much more of a concern for me going into the next year.
That's something we'll be watching. Check these two charts out just to put this in perspective. 36. This is the U.S. data center build out by year, just to give you this is from Sapphire Ventures.
Oh my God.
And you can see planned in 2025. This is on gigawatts. So obviously, you have to get to 90 gigawatts to get to AGI, according to, the experts. You need 90 gigawatts of power, and we just started. And now if you go to the next chart, this is the electricity generation this is how far behind we are versus China. So this Genesis plan is essentially we got to catch up with China for the stuff. And so this might be the beginning of it from a national security perspective in AI, rather than the end of it, because we need to catch up to China. And this is existential, according to the government and your tech bros, which I don't know, I'd push back a little bit on, but maybe I'm not that smart. My point being is that if you go back to the Sapphire chart, that this could be the beginning of it, of the blow off, we're getting into the crazy euphoria stage. Maybe in 2026, if you see these numbers blow out, this will go even more. But it's really hard to call a bubble when the government's behind it, or so early.
Yeah.
But you look at this number and we're in the early stages. A lot of people are talking about next year instead of the year, the hyperscaler and the CapEx spending beneficiaries next year's, I think it was Goldman or someone really support. The winning companies are going to be the usage of AI, how the people who make their systems more productive and use the agents, etc. That's all going to increase. We know AI usage is going to go up. But the thing about the capital requirements is, 2026 numbers presumably going to be even higher than 25. And so 2026 number will be 3 times of what the build out expenses were last year. And so you get to a point where real life bottlenecks start to show their face in terms of capacity, build out, commodities, labor. And when I see that chart, that's an awesome chart of electricity generation in China and US. At the end of the day, let's just assume that the technology converges at sort of the same, whether it's DeepSeek or OpenAI, whatever, the technology kind of converges. There's tons of secret sharing and all this stuff. At the end of the day, it comes down to compute and who can power. And just by this chart, it's virtually impossible over a long enough time horizon, if this trend continues, for the US to win this race based on power generation.
Well, I think that's why they're trying to break down all the regulation for nuclear power and,
Venezuela.
I read something.
Yeah, you have to.
There was this, I don't know if you guys ever read this. It's the Rational Optimist newsletter. These guys write it, who are awesome. Dan Steinhardt. And Matt Ridley wrote this thing on nuclear fusion, which is essentially fission is if I get this right, pulling atoms apart, and but fusion is smashing them together. It's what stars made out of with energy, and it's limitless energy. And he was basically saying there's real breakthroughs on nuclear fusion where we could kind of see, I don't know, if they break down all these roadblocks, you see a lot of the government secrets kind of going to the private sector. We could see kind of a boom in the energy field in terms of to catch up with China. And I think that's partly what the Genesis plan was supposed to do.
Yeah, man, I just see energy and metals is such a bang up trade for the next year or so. You have, it works in a lot of different interesting ways because, if you own especially the precious metal side of things, you there have this hedge on the national debt situation, on central banking irresponsibility and, independence erosion. You also have this dynamic where if real rates come down lower, if they start to meaningfully cut, that's going to be positive in that situation. You have this sticky inflation idea, which is that we're above target for years. So, you want to own those types of assets. And then you have this fact that the whole supply demand landscape is just completely being shifted. We're hitting these big bottlenecks now. And to Quinn's point, they're physical bottlenecks now. You've been seeing natural gas has been surging, and Citrini has been all over this. Who always has some really great insights on AI, and he's super bullish natural gas because in his eyes, it's just we are hitting these major bottlenecks in commodities and precious metals. And yeah, it just feels like such a great thing that can work in so many different regimes.
Yeah, we have a precious metals strategy here that's, we're seeing it firsthand how good it is. And it feels early too, because you can sense the liquidity in some of these stocks. This is public information, but Carson published at the Irisone conference, he talked about a long gold stock. And
which one?
Snowline Gold. And it's
he said the ticker.
Well, no,
I'm kidding.
Oh, got it. So I get it. But anyway, the liquidity in some of these things, even after crazy rips higher in some of these, it's non-existent. And this is what happened. You've basically concentrated a generation's worth of asset management in other sectors. And so even if you get a tiny inflow from pensions into another sector, it causes an asymmetric move. It's kind of what happened with crypto when crypto was like really tight, the floats were really held tightly, and now you get this rotation is like, but the funny part is passive is always late to it, and then they can push it for years. I mean, like as long as the strategy. So my point being is that I agree with you. Like I think a lot of these things are going to rotate, and the quant and systematic strategies are just starting to sniff them out.
Like Tyler, you were saying about uranium, like the US is now finally embracing uranium after such a long hiatus. It's like China's looking at, they're like, oh, that's cute. You're going to like approve some things that take 10 to 15 years to build. Oh, we build 10 new nuclear power plants every year and have leapfrogged the whole world by an order of magnitude. And so, but I agree. I find metals to be also another interesting point to everything you mentioned, Felix, is these floats are small. They're more liquid than like oil, and you don't have as much of. I mean, you almost have the opposite of. The U.S. is trying to secure supply of these rare earths and metals, but they're not doing it with the same vigor as they are attacking oil prices with all the deals and trying to trying to have Ukraine over to Russia to end that war, trying to take Venezuela, like all of these, the Saudi deals, it's very obvious. They talk about it. Trump's talked about it before this administration, et cetera, and Besant talks about it, lowering the price of oil. So the other thing with metals that you have is you have an inflation protection asset without the one-way train of trying to increase supply as you do as oil and the life cycle, right? So you can drill oil wells that comes, if US is going to do some stuff in Venezuela, that oil probably comes online in 2 to 3 years or 1 to 3 years, depending on how bad the infrastructure is degraded there. But, metals, this takes 10, 15, like these are long life cycles. So if you're trying to, quadruple the supply of data centers and lithium batteries and et cetera in short time frames, you just have to run into supply chain bottlenecks and
supply shock, man. If you're thinking about buying crypto but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Well, last point on that before we pass it is, I also think you've had 15, 20 years of climate change narrative that is now breaking. And regulatory wise, like if it's a national security imperative and supply chains are breaking down, the regulations to actually drill for some of this stuff are going to change immensely. And I think the social zeitgeist, if you will, is changing as well on some of this stuff. Because people are hurting, right? Like
what's a good example of this up here in Canada is, so Mark Carney's the new prime minister, central bank governor, pretty pragmatic guy, a bit more centrist than Trudeau, that's for sure. And he's pushing forward with new pipelines up here, and he's making agreements with the Alberta premier. It's like if he's not as left wing as Biden, but imagine if Biden was making a pipeline deal with Ron DeSantis. Like that's what's going on up here in the north.
Oh wow! It's so painful they have to do it.
Yeah, exactly. And you know what happened is that the previous environmental minister up here, I think his name's Stephen Guilbeault or something, but he was a Greenpeace activist. He's been arrested multiple times for all that stuff. And so he was part of the cabinet of Mark Carney. And the day that they announced the new pipelines, he resigned from the cabinet. Wow. So you can see the zeitgeist shift. Like this Liberal Party under Trudeau, like the guy our environmental minister up here was a Greenpeace terrorist guy. And now Carney's pushing through pipelines, making deals with Alberta. Yeah. And the Greenpeace activist minister is resigning. Like things are changing. It's
Go
crazy.
Canada, baby. Go Canada.
Oh, dude, I'm bullish Canada, man. I think people are sleeping.
We're
not doing real estate Ponzi's anymore, man. We're building pipelines.
You want to know a great story? I worked for this guy in Boston. He was the CEO of Fidelity Canada for years, and he wrote this book called Go Canada. It was like I think it was like 2012. Brilliant guy, and the hard part was he nailed the Canada thesis. Is like it's all natural resources, is great market for all, providing the entire world for all this stuff. And then, but what happened was the dollar broke out from 2012 at that point, and it was like 1-2 good years of Canada, and now it's finally come back. And like over the long term, I feel like it's like Canada and Australia just love like digging stuff up out of the ground. It's just like,
yeah.
An interesting angle is like, I would not be surprised if some of Canada's like throwing out the green stuff has been as a result of Trump's pressure, because Trump needs all these natural resources from partners and close allies, and all these pipeline deals, a lot of them, cross the border, etc. And, maybe that's what's cooled some of it, because they've said, fine, we'll start drilling, we'll start digging. Like, Canada sits on a huge amount of resources, and, for many of the last bunch of years has been co-opted by the green stuff, and, cut off a lot of the oil sands. The banks cut financing access. So yeah, they have to, like, it's a huge priority, and it's strategically extremely important and prosperous if they do it.
Canada's like the Saudi Arabia of uranium. Did you guys know that? Well, there's one. There's one
in Saskatchewan and the Canadian Shield. We have a shit ton of uranium.
So this Genesis plan is like opening up nuclear. We're turning on our nuclear reactors again. Like it's very, I don't know. There's a lot of interesting stuff. Who said Canadians were boring? Like you, Felix.
Exactly. Yeah, we're not bored now that we're not just being distracted with real estate Ponzi's, and we're actually trying to do something.
Exactly. You're harboring money laundering from global oligarchs in your real estate market.
Yeah, we realized that wasn't sustainable.
Yeah. Oh, probably shouldn't have done that. Oh, sorry.
Yeah.
Sorry.
Oh, sorry.
So sorry. Sorry, you're on middle class.
I gotta change subjects before we start getting all our Canadians to unsubscribe from us.
Yeah, they love it.
I love it. No,
they're too passive aggressive to say anything to a Jersey guy like me.
Yeah. So I'm not going to be. I'm going to let you just steamroll it.
Yeah. Let's just keep going. Pass it.
That's it. Okay. Let's settle down. Yeah, it's looking like we know who the new Fed chair is going to be. It's Kevin Hassett. Trump mentioned that he's going to be announcing early next year who the Fed chair will be, but basically 12 hours later, he was in a speech, I think a cabinet meeting, and basically all but said that Hassett's going to be the Fed chair. So we see that surge now, 83% odds on Polymarket. And this was an interesting tweet from Nick Timmeros, just saying that Trump's plan to replace Powell, get rate cuts. The problem, what if a new chair can't deliver the votes? The unusually deep divide over potential December cut, which doesn't happen unless Powell forces it, underscores that this isn't a hypothetical for 2026. The Fed chair is like a quarterback. He calls the play, but the rest of the players have to run their routes for it to work. Fed veterans worry about what happens to the institution's culture if a new chair struggles to deliver the cuts Trump is expecting. So it feels like there's this expectation in markets that Hassett, as the biggest Trump stooge in the running right now, will come in and just slam rates to 2% in quick order. But I'm curious how you guys are thinking about some of these tail risks of, like, we're already seeing the FOMC so divided right now on just cuts for December. And, you have to get all the FOMC on board, or at least the majority of them, to pass these votes. And, can somebody like Hassett really get that done is the question. And I'm curious how you guys are thinking about it.
Nuance is always lost in our forms of communication and media today. But the thing about looking back at other Fed governors, obviously the person matters, but the circumstances of the market environment and economic environment also matter. So, like, where we're at today is there's a growing distaste for inflation, distrust of institutions, appetite against, this wealth inequality, but it's not to like a fever pitch yet. So I think there is more for this to go. I do think they get the cuts they want. And at the end of the day, if 4 or 5 out of the 12 become Trump appointees, what's the like? And if you're one of the others, what's in it for you to stick around, one, and just be fighting like these difficult battles, like so people will just fall off, and two, like what are you achieving or doing for yourself by sticking your neck out and being the person that is the target of the Trump wrath? So I think ultimately they will. With that said, though, the market environment matters. Like this right now, people are still pretty scared about growth, so that helps them get things through. Like the broader market, in commentators and participants think the Fed should be cutting, quite aggressively. We're not yet to a point where the Fed's like embarking on something that the market is like strongly disagreeing with. But, in like the Burns Volcker time, like Burns, it's sort of like, maybe Hassett's like a Burns because like the environment allowed for, let's say the cut, the cutting and to kind of give in to the president. Whereas at the time of Volcker, when he came around, it's like there was other factors outside of him that allowed him to kind of keep this very restrictive stance and end inflation. People were sick of it. It was too much. Like they needed to do this. So I think it will, but yeah, what assets perform? I mean, what's going to really confuse people probably is when they do start ripping these cuts off and the economy's fine because spending is still 5 to 6% deficits and the long end starts going up and, middle class across the country is like, wait, you're cutting rates by 50 bips and our mortgages are going up. What the heck?
I think they're gonna jimmy this thing so big, dude. Like the boomers want exit liquidity, so they want lower rates because they're like, oh, I need to pawn my house off and to the next generation. There's gonna be a massive turnover. They're gonna jimmy the system in ways you can't even imagine. And I'm sure the meeting was like, Hassett, what we need you to do is lower the interest rates by 200 basis points. We need to roll a lot of debt next year. We need the boomers to sell their houses. We need Quinn and Felix to own a house. Okay. It's turning Italian. I don't know. But anyway, I think that's literally what it's all about, the next generation pass through housing so that you can have children. They'll figure it out. Even if the Fed has to raise the inflation rate to 3%, whatever, they got to roll this debt. Just imagine if they don't. The K-shaped
house prices boom though if they do this stuff. Like I agree with you. I agree they're going to do, stimulus, whatever.
Yeah.
But it's you can only, it's a weighted machine. You can't just create out of thin air. So if they do all of these things, if they do give stimulus, if they do incentivize first-time home buyers, if they do all these non-rate things in tandem with rates, that just puts house prices, or at least parts of the house price market, up. Like
I agree. I think that's what, if you look at like ITB,
they're stuck.
They're starting to sniff it out where I think banks are even rallying now. Banks were falling off a cliff and now banks are back going to new highs. So I don't know. I think they're going to jimmy the hell out of this, and by hook or by crook. And whether it's policy, and if it's policy that moves the needle too much in the 30 year, they'll stop issuance of the 30 year. They're going to do all sorts of stuff. And you just what you have to do is basically trade when sentiment gets too bullish in something. It's like, oh, we'll just take the air out of it by messaging. This is the new centrally planned economy. It's like all verbal off of market indicators, forward market indicators, and you just have to fade them when they get extreme.
That's what's so hard right now about translating that into just trading and market price action is like we're in the doldrums right now. Like there's very little incentive for them to really gas it right now, and so you're seeing that in market price action. At the same time that we're having these liquidity hiccups, like we haven't even talked about it, but we're still seeing, despite QT ending this past week, like the standard repo facility is still seeing a lot of uptake. We're seeing some stress in plumbing markets. So you have these jitters where it's not bad yet. I'm not saying there's a crisis looming or anything, but it's also not great either. So you're just in the doldrums right now until they're ready to gas it. And yeah, I feel like it's, I don't know, two more months of this. I don't know how you guys are thinking about it, but it's just like, I'm trying not to overtrade. I like my metals positions. I still own some equities, but also a little bit concerned there. But yeah, just kind of sitting and waiting for the next fat pitch is kind of how I'm seeing it.
I think you got to pick your secular themes that are backed by government policy, and that'll lower the internal volatility of the sector. And what's really hard is when the systematic guys get fully invested, you have to essentially know that like a vol spike is coming at some point, and then lower your risk, because these market structure things just can really shake you out. And I think that's largely this last pullback in momentum has just been, CTA unwind, and now we're seeing vol. Here's a good chart for this, slide 35. So we saw the VIX invert. This is when I was a little nervous. Credit was constricting, and then all of a sudden, if you go, vol is down in Eurovol. That's the top one. 9-day VIX, VIX 1 month, VIX 3 month. The vol of the VIX, the implied correlations, move index, and the VIX on the TLT, all down, over the last couple of days. And especially like if you look on a 5-day basis, just implosion in vol. And this is obviously like the seasonal pattern in December. Not much is happening. No real stuff. Fed expectations for an easing or 90th percentile. So there's really not that much going on. And then you get some economic stuff, but that's it. But that's largely the name of the game right now.
Yeah. I mean, I don't know how like crazy anybody really wants to get in the last 3 to 4 weeks of a year with extremely, shortened holiday periods and lower volatility, and the Fed obviously cutting, and then the White House using the Hassett card finally. They've known this for a while. Everybody's known this. Like they need, like, Warsh, I think I might have said this last week, but he was way too Powell-esque type of a choice, where there's too much risk that he wasn't gonna, it's not like
go rogue.
Yeah, he didn't sit in the White House for a year. So, they strategically use these cards at the right time. I tend to agree. I think like the metals stuff is really interesting, because that can benefit even in, volatility if you got gold in there. And as Tyler, you mentioned, some of these secular themes do well.
Check out this chart too. This is a good fodder for talking. This is slide 34. You guys will get lots of ideas off this. The investor allocation to bonds. And I don't know what changes this. Like, you could, in 99 and 2007, that was pre-crisis. Now, if you get a crisis, like, are you going to bonds with a deficit that's big? So like,
as soon as the margin calls end, you're going into gold. Like, that's what we saw in April. As soon as the margin calls ended, it ripped.
Yeah, I think the vol on the metals assets is way too low.
I mean, in the short term, they feel a little frothy, just given the move. But I can't. I think they're secular plays. And what's also interesting is, like, remember the 90s bull market in gold, where you got all these famous investors like Eric Sprott and, Rob McEwen and, Ross Beatty. You knew all the gold investor names from that period of time. And now they've all like pretty much petered out generationally. And there's no real new gold names there, and like of rock star gold investors. Isn't that kind of fascinating? Like, you don't.
Same with oil and gas too. I mean, same with LATAM, all these secular value cyclical industries that got just pillaged, because of government policy, have gone by the wayside.
There's room for a next generation. Like, Quinn, you could be the next generation, Rick
Gold guy.
Rick Roll.
I mean, we start throwing some forward guidance, gold conferences. You're spot on. Like, you want to be positioned long through, we all know VIX is sitting at like 16 or whatever it is, but so it doesn't feel like things are crazy, but we will get these insane 15, 30-minute vol spikes, and then, someone will come out and tamper volatility again. But you got to be in these longs that I would not sleep at night being long Mag 7. That's just not how my brain works. I understand the Ponzi can continue and et cetera.
Yeah.
But like we talk about, it's like the amount of liquidity needed to support these behemoths means that if you just find things where that liquidity wants to travel, like you said, Tyler, government-backed emerging markets or emerging industries that are trading 1/1000th of the market cap, and you're like, okay, just wait for the government to add that liquidity to support the Mag 7, and presumably like some of that capital flows to these emerging sectors, and that triples their market cap. Like,
yeah,
yeah,
dude, copy trading the government is been like a banger. And you know who called this so well was Russell Napier in like 2021. He's just like, we're in a regime shift, inflation is coming, financial repression, governments are going to be overweight in open markets. Go to as close as possible to where the government money spigots are and just set up shop right there. And he's been completely bang on for the past few years.
Here's a tail risk thing. I'd love to read this to piss people off, but also this is a bit microstructure-y. But to your point on the FANGs and being so concentrated, no one talks about this because no one's close to trading. And like I've been trading like real trading, not like retail trading, like institutional trading. And this is slide 38. So Joe Saluzzi, who's like expert market structure guy for Themis Trading, he's on all these like national panels, etc. Said this to me. This is from July 8th, 2011. It was after the flash crash from HFT, and this is a speech from Executive Director Andrew Haldane for financial stability for the Bank of England. And basically he says, he discusses several policy options to manage the impact of these developments of systemic risk. But he says the topology of trading has potentially increased systemic risk. And he says, this is the second paragraph. The cause of dislocations in price may be the disappearance of liquidity in situations of stress. Haldane argues the advent of HFT and fragmentation may have made this more likely, with HFT firms more inclined to withdraw liquidity. Meanwhile, longer-term investors may either be unable to or unwilling to fill the liquidity gap because HFT activity makes this unprofitable or risky. The result is a potential liquidity void and a greater dislocation of prices at times of stress. Many of these features were evident during the so-called flash crash of May 6, 2010 with HFT, adding liquidity during a monsoon and absorbing it during a drought. He states that the new topology of trading markets makes it more likely such price dislocations will be transmitted between cash and futures markets, between different exchanges and trading platforms across stocks. In other words, high frequency, localized price disturbances could be magnified across time, markets, and assets, as Mandelbrot 2 would have predicted. The upshot, he argues, is a latter-day tragedy of the commons, the competitive race to zero risks, amplifying price abnormalities in a way which benefits no one. And so this is 2011 when HFT was, small relative to it is now. Now Jane Street and Citadel and all these Hudson River.
It was like the Flash Boys era of like the Michael Lewis book.
And it's still going. Yeah. It's going, and they're making even more and more money. This is the centralization thing. Is like you literally like replace like real price discovery with just like a passive mechanism for price discovery. It's all the Mike Green stuff, But my point, to wrap it all with what Quinn said, is like it makes holding in size some of these FANGs even scarier when the market structure is built on just dog shit. Like, yeah, sure, in the short term, but the government's always there to like bail it out. That's what we're finding out is if you do get a price dislocation and everybody's all invested and you can't bid at a certain price, then the government will just bail it out. Hence, the
here we are. Yeah.
So you get my end point is like you just got to bet on the frontier markets to stay ahead of the inflation. If you don't want to bet on the FANGs, because the FANGs will by nature, but like it's antithetical to actually put an incremental dollar as a regular human into such centralization, because like eventually centralization, it's just like cancel culture. Centralization will come for you no matter what. And so like your only opt out is really crazy high vol, long duration stocks, or, the low volatility way to play it is probably metals and mining or crypto in a lot of senses. So like there's like three ways to pull the ripcord to get out of this thing as your average investor. But the market structure is so fucked. It's, excuse my French, it's so bad. And it's going to come home to roost either in like a hyperinflationary thing like Weimerica or a crash. And you can't really, there's no like muddling through this anymore. Talk about national security risk. Like, think about that. All of a sudden you go to sell, your passive is like, oh, let's go sell. And there's no bid. There's no bid.
Yeah. I think the geopolitical stuff, while I don't think there's really many trades off it, but it seems to be heating up with the frequency of meetings, the Venezuela stuff, the Ukraine, Russia. It's just interesting. I think that might, like, it just feels like we're getting to a smaller and smaller deck of cards to be flipped over and rabbits out of the hat to be pulled to like keep oil down. And sort of, if you're bringing out Hassett, that sort of gun, like, that's a big gun to be using. I think the real question everybody should be asking going in 2026, like the real fun over under, is what month of 26 Trump starts berating the new Fed chair. Like, that's it's happening. Yeah. Like, guaranteed it. I want to get a poly market going. What month?
Yeah.
Because everyone's got this like, oh, he's, the new Fed chair is going to do all this, blah, blah, blah. Like, what month is that in 2026 that he's going after the Fed again under his leadership? And that's coming. Like, we know that is coming.
Man, I mean, there's a good chance of one of those meetings where you get a 50-50 stalemate on one of those meetings.
Exactly.
And yeah, like that would.
And then he's coming for Bessent's head too. And that's where you get the real ugly kind of cat fight is because he's putting, he's already done it, kind of put ownership of the Fed on Bessent. And there's only so much the guy can do. I mean, he's like moved mountains already.
I mean, or Powell refuses to resign,
to leave.
Like,
yes,
he just like that's a tradition, is that he but it's his choice. He could stay on the FOMC and hold up that seat, which that changes a lot of things.
I kind of think, based on what's happening, actually, I was just thinking about this a bit. I kind of think he hasn't told them what he's going to do yet, because I think he's used that as a card to say, hey, get off my case or else I'm staying. And
100%.
I don't think he wants the responsibility. He's actually, I got to give it to him, he's managed this quite well. Like, talking out of both sides of his mouth. And now he sees the K-shaped economy. He can say, oh, you know what? I don't want to be the face. Let that.
Oh, no. I mean, no, but what we're talking about, Tyler, is because his governor chairman status obviously falls, but he still has the seat on the board as just a regular governor for a couple of years.
Oh, gotcha.
And so, but if he stays on, that hurts.
Trump couldn't nominate into that seat. He would be holding up that seat.
Okay, gotcha. Yeah.
And then Moran's seat is full time, and you have this kind of total control. But it's gonna be fun, man. I like it's that's why we love this shit.
Yeah.
Yep. Never ending game theory.
Cool, guys. Always a good one. Happy to be back after a long weekend. Until
crazy. It's December already.
Oh, wait, hold on. I got to get this one last good story. So I call up, I got this giant, like, cool oak tree in my backyard. It's like one of these old, like, Southern giant tree, like beautiful tree. Not like so enormous. So I call up, I want to put like some lights on the tree. And I get this like ad on Instagram. I was like, oh, I was probably listening to my, I'm going to get like 10 of these now because they're listening to me. But so this business was like, tree lighting, we'll light up your tree. And I call them like, how much is it to just do one tree? Like one tree. What would your guess be for like one tree? And like, there's the trunk and then there's the branches. Guess.
$500.
Felix?
1,500.
So just the trunk was 2,000 to do the whole tree. He said it was probably around like 8,000. And I was like,
holy fuck.
I was like, dude, I'm old. I'll get up there do it myself on the ladder. I'm like, are you kidding me? Who is paying $8,000 for a giant? Like it's not even that giant. It's a big, nice tree, but like that's insane. I'm like,
that's the deportation crew coming through and taking all your labor.
Maybe that's what it is, but Big Tyler's going to Home Depot and get his own license here.
Well, be safe. Get a harness or something. We don't want you rocking up next week in some neck brace.
I'm just gonna send my 7-year-old up there and be like, "Hey, Bo, figure it out,
buddy.
This is slave labor. It's a new economy."
Yeah, times are tough, pal.
Yeah, we gotta keep up with inflation here.
Yeah. Good way to end it.
Nice. Well,
cool, guys.
Happy holidays.
Yeah. See you guys next week.
See you, fellas.
Later.